Jay Rollins, you are a real estate investor and Donald Trump is a real estate investor. So would a Trump presidency be good for guys like you?
In short, a Trump presidency would be good for guys like me because we are primarily distressed and opportunistic investors, which relates around volatility. A Trump presidency would bring a tremendous amount of volatility, which would bring opportunities. So certainly in the short run, there would be a lot of volatility in the market, people would be exiting, people would be nervous, and that creates a lot of friction in the market, which is good for us.
All right, and before we get to your portfolio and what you're doing nationwide, what about a Hillary Clinton presidency? How would that affect commercial real estate, which is your purview?
A Hillary Clinton presidency is going to affect commercial real estate through primarily 1031 exchanges and taxes. And there's going to be a fear that the 1031 exchange is going to be attacked under a Clinton presidency. So I predict that you'll see a tremendous amount of sales volume early on in that presidency as people are looking for tax shelters before she can enact higher taxes.
All right, now let's talk about JCR Capital. And we'll start off with the overall market. I know real estate is local, and it's location, location, location. But what about the big talk that there's a bubble in commercial real estate right now?
Well, there is a bubble in commercial real estate right now, but I think the important thing is it's a bubble that's not going to burst like we saw in 2008. It's a bubble that's going to slowly deflate. And we're projecting a 3 to 10% decline in commercial real estate, which will disappoint equity, but will not affect the debt. And that decline is being driven by higher cost of capital as private money replaces the banks, and by a slowdown in revenues as the top line growth just has to stop as we're in a slow growth economy. And so we see a slow decline in commercial real estate, but not a drop.
And let's drill down a little bit further, because as I said, real estate is location, location, and location. You focus a lot on the West Coast. How is the West Coast doing in the strip malls, in the malls, in the retail spaces where you operate?
Well, the West Coast malls and the East Coast malls, if you're just talking malls in general, I think we can say the same thing. You're seeing that the B and C malls around the country are dying. And you're going to see a lot of redevelopment of those B and C malls, primarily into multifamily and to other types of housing. The internet has just depleted those malls. You'll still see the power center malls continue, but you're going to see a changing real estate landscape as it relates to the B and C malls all over the country.
And talk about how demographics is playing a role in what's going on in commercial real estate right now. A lot of properties are getting handed down from an older generation to a younger generation. What does that mean for your business?
Well, JCR Capital primarily plays in the middle market, which we describe as assets under $50 million. Assets under $50 million are owned by individuals and partnerships of individuals, not institutions. These individuals tend to be between the ages of 50 and 75. So you're seeing the greatest demographic change of real estate ownership in the history of this country. And these assets are coming to market with no correlation to the macro market, and it's creating a tremendous opportunity for buyers and financiers in that middle market due to the aging of America.
And then one more question. A lot of worry about REITs as we get closer to Fed rate hike, because the odds are that they are going to hike in December. And what's the effect you think it's going to be on the entire real estate universe if REITs come down because they've been acting like a bond proxy?
Well, our view is lower for longer. Another 25 basis points is not going to make a difference. The real thing that's going to make a difference that people are not talking about is that the regulated capital is coming out of the business, unregulated capital is coming into the business. That unregulated capital is more expensive. That is going to drive up capital costs much more than the Fed will drive up capital costs.
Jay Rollins, thanks for coming on.
Thank you.
And thank you for watching The Street.